Hey everybody, Preston Bryn here with our weekly roundup for the trading week ending March 9, 2018. Before I jump into the screen today and kind of go through the week and kind of what I'm looking at for the following week, we did see this week the Dow was up a little over 3%, 3.25. S&P was up 3.5%. NASDAQ was up a whopping over 4%, 4.17 about. Treasury yields are holding just slightly under 3%. Now, it seems like years ago, but it was only in early February when we got the January employment numbers, and I think that set off, well, not I think, I know that set off the market tantrum that we had, the temper tantrum. We had not really impressive employment numbers, but the wage growth scared folks. It moved over 3% year over year. So that in turn um, increased the expectation of 4 rate hikes for 2018 versus 3. That moved the markets down dramatically. It drove volatility up. There were a lot of reasons why volatility moved up, but I think this was more a volatility-induced correction than it was a market-induced correction, because we had everybody and their uncle playing short vol for the past 3 years, and it just built up huge position sizes. And when vol started moving up, those people that were short vol had to cover. And what that did was create an exit to the door. And there were only so many people that could get through that door at the same time. And I was reading where orders were coming in after market close of hundreds of thousands of contracts being closed out, which really drove volatility up. In fact, it caused the liquidation of a well-known volatility ETN, XIV. And that just caused a lot more complications in the market. I think a lot more so than necessary, but that was an imbalance in the volatility market, and it just caused the markets to go really what I would say batshit crazy. But that precipitated it with those early February employment numbers for January. Now, this past Friday, we get employment numbers that showed a huge expansion of about 313,000. And the markets weren't expecting no more than about 200 in the low twos. So it's over 100,000 more than what people were expecting. Employment was holding steady at unemployment at 4.1%, but the big kicker was that there was subdued wage growth year over year. So in many respects, this was like a Goldilocks number. And indexes initially moved up and then down, and then they kind of settled in. They read the details behind the numbers, and they just took off for the day. I mean, just a really strong day. And then towards the end, we closed near the highs for the day, which gave us the strong up week for the Dow, S&P, NASDAQ, Russell, everybody. And Treasury yields, as I said, are holding underneath the 3% level. And what we saw as a result of this past week, 3 rate hikes now seem to be more the norm, at least according to the CME tool that they have on their website. There's a 100% chance of a rate hike this coming March 21st. Now, the Feds are meeting 20th and 21st. As you know, there's a lockdown period 10 days before the 20th. So starting on March 10th, I guess that would be today, you're not going to hear anything from the Feds until they meet on the 20th and then the 21st. This will be what I call Power Ranger Powell's first press conference, where he bellies up to the mic and he talks. And let's see, I think he's kind of learned his lessons, much like Yellen did. And everybody's going to be listening to what is the projected dot plot and path of rate hikes for the remainder of 2018. Remember, it was 3 versus 4. And when the markets had a 75% chance of 4 rate hikes based on those early February, Jan employment numbers, the markets did not like it at all and sold off into a correction territory, more than 11, 12%. So now we're back to a 3 rate hike cycle with these Goldilocks numbers that we saw on Friday. We got about 100% chance of I don't believe there's anything in these financial markets as 100%, but let's just say close to 100% for a rate hike for this March 21st. We've got a 77% chance of a rate hike for the next quarterly in June. That would be June 13th. And for the 4th rate hike, they're projecting about a 77% chance before the end of the year. Our 3rd rate hike. The fourth rate hike has moved from 75% down to 34%. So all of these numbers essentially mean the markets are moving off a 4 rate hike cycle and now saying as long as wage numbers stay subdued. Now next week we get on Tuesday CPI data, Wednesday PPI data. So trust me, the markets are going to be watching that data very closely for any signs of inflation. And is it going to be 3 or 4 rate hikes this year? Remember, one of the things I was telling all of you guys, and and for our members as well, one of the biggest fears in 2017 that could muck up this bull run that we're on are the Feds. They giveth and they taketh away. And the taketh away part would be they increase their rates too quick and they actually push the economy into a recession. But more on that later in future sessions. So this is kind of where, and to top it off, this week we also saw Trump come out with steel trade tariffs. Cohn resigns as economic advisor. Markets reacted unfavorably to that, but essentially has wiped all that gap down when he announced his resignation off the books. So that's now a non-event. And then on Friday, we get the illustrious ho-ho hostess twinkin eating freak from North Korea, Kim Jong-un, wanting to meet with Trump. And Trump says, let's do it before May. So I'd love to see that meeting. I had suggested to our members that, Trump loves McDonald's, and that guy, he's not a health freak. So why don't they just meet at a McDonald's? They could share a Big Mac, fries, and some apple pies, and a large soda. Diet soda, of course. I think that would be pretty funny. Discussing thermonuclear war over a Big Mac and fries. But anyway, a lot of activity last week. Risk is back on in the market. However, I am seeing over the past year some macro changes taking place in the market. It used to be a lot of big funds allocated 60-40, 60 equities, 40 debt, but we're not going to see debt hold its own with downdrafts in the equity market like it has in the past. With the Feds not supporting lower interest rates at this point in time, only higher interest rates, I think when equities sell off, we may see a little bit of a move higher in debt as a flight to safety, but it's not going to be much. So this regime change is going to cause some correlations to change. Allocation models are changing. We're seeing some risk parity models changing as well. And this reallocation we're going to see occur as we move through 2018 and prep for 2019. Remember, I also said that I expected a bear market in about a year to a year and a half, and that was about 8 months ago. So that would put us on track the end of this year or into 2019. Now, I'm always leery of people making forecasts, my forecast included. At the end of the day, we follow price action. But that's just kind of where the markets seem to be lending themselves right now. All right, let's jump into the charts here. I've jawboned enough. What you can see here is a weekly chart of the E-mini S&P 500 futures. You can see this downdraft here and this move higher. Now, as you probably no doubt know, topping actions, the way the markets finish higher or lower, right? I mean, it defines, is the bull market over? Now, that is the peak here. I will note that NASDAQ made new highs. So that tends to wipe away, is this bull market over in the near term? I don't think so. But generally, when you have a move higher and then a pullback, what we want to look at is that key pivot there of the highs. We want to take that out. Oftentimes, bear markets start with lower highs, and it can be very insidious because now we move back up, and let's say that was the February 5 lows, and then we just kind of chop here, and we're making higher highs in a very short-term basis, but we can never take out that prior all-time high. We may even come up and test it, and then we come back down, and then we end up chopping between this pivot low and this pivot high until one of them breaks. And the end of a bull market, obviously this breaks, and we start making lower highs and lower lows, okay? Now that is how a topping action happens on a longer term basis for all-time highs. If we take out this prior pivot high, which would be our all-time highs. Then what that tells me is this gives this bull run at least another 6 months, possibly even a little bit longer, to continue to chop and make some higher highs. Okay. I really try and avoid listening to these TV talking heads because every one of them's trying to make a name for themselves. What they try and do is say, we're going to go up to 3,100 or 3,300 in the E-minis, or we're going to fall back down to 2,000. Now, one of them's going to be right. And the one that's right earns kudos and repeated invites to other business channel TV shows for the next year or two as being accurately calling the prior move. So they're viewed this way as kind of a soothsayer, and I think it's all crap. All right, they're just guessing. All right, you do not know. You've got to let price action dictate where we're going to go, and anything can happen, folks. So looking back at this weekly chart here, you can see if I run a Fibonacci on this, let's just run a longer term fib that goes all the way back to this really when we made lower lows here in February of 2016. So let me just run a fib on this thing here like this. And I'm just going to run it from the lows all the way up to the top right here, roughly like that. All right. So you can see in this fib node here that we came down, and this is where we closed for the day, right? It wasn't necessarily because we're looking at the futures here. But you can see here on this longer term basis, this kind of formed the on a weekly chart where the markets ended up at the end of the week. Okay, we moved here, but the markets always overindulge themselves to the downside and to the upside. But we kind of held steady at the 2.236 level. And now we're moving back up. We've taken out that prior pivot high right there. And now we're sitting in this area here. So for me, I'm going to watch this level very, very carefully. And this may not be exactly correct because I'm looking at, I got the live price here. I'll show in just 1 second. But you get the idea. If we take this out, that is a very good sign. Right now, we've got a very wide range that we're going to play on a weekly basis, and I'm going to watch these, right? It's a little over 240 points, 250 point range. And if we take this out and then proceed to take out our prior pivot lows made in early February, then the next hold off point is around the 2464 area. And then you can see here as we move down the value chain, kind of where we will end up. I don't believe we're ready for that yet. You can see here this upward momentum in the MACD that would suggest that any sell-off is going to be bought. And that's kind of what we had here. All right, we had this sell-off and then we bought. So if I take this in, and let me take it into a daily basis, and we'll kind of just zero in just a little bit more on this so that we can get a little bit better of an idea. You can see here, let me just take this back off the screen. You can see on a weekly basis here where we're sitting, okay? And let me just put my other indicators back on the screen. You can see the 2018 open price. You can see we pull back 12.14% from our all-time highs of 2878.50, okay? We're challenging the prior pivot high here, roughly 2789. Let's call it 2790. If we can pass that and hold it, we've got a resistance zone slightly up above us before we are free to run and make new all-time highs. Okay, so this is what I'm going to be watching for. The 2018 open price, it's a psychological barrier, 26.75, 25. I'm going to watch that very closely. But we're clearly in a strong up move. On the 2-hour chart, which is a great swing trade time frame, you can see here on this swing trade time frame here, where we had this massive, and we tested it twice, right? We pulled back, and then we came right back down again. We tested it again. We had massive. We call this, what I call this is our poor man's bud, which is a poor man's bullish divergence. But that is a trigger to go long right in this area right here. Okay. And it would have been a good run. Again, right here, this volume over price was very high, so I expected resistance right at this level right here. And you can see we just kind of floated up and above and below this thing for quite some time. And we stayed in a chop mode for quite some time. And then we finally broke out and we're challenging this pivot high right here. I wouldn't be surprised to see us pull back into this area, rest a little bit, get some strength, and then move back up. That puts us down around the 2730 area on a short-term basis. Wouldn't be surprised to see that at all. Now, keep in mind, we get PPI data and PPI data, CPI and PPI data, consumer price index, and then the producer price index. We get both of those on Tuesday and then Wednesdays, respectively. So that could move the prices up or down. But this is kind of what I'm looking at on a very short-term basis. I mean, you can see this massive move that we made starting on the evening of the 6th of March. And then Wednesday, Thursday, Friday, it was just a rocket ship straight up. Okay. It was a rocket ship up. You can see this gap down here when Cohen resigned and the markets opened up right here, or they closed here, and then they gapped down. They made a run down. But I said, as long as we hold the 2018 open price, we'll be good. And then we actually closed that gap within the next day or so. And then we just took off. And then the big February employment numbers really drove us a lot higher. I mean, really amazing. So the markets here are not in the mood right now to come down and test these prior pivot lows. Okay. I do believe a little bit of, we may see some momentum carry us forward, and then I'm expecting a little bit of a slackening in price, if you will, midweek, and then we'll see where we want to go towards the end of the week. All right, so that's kind of how I see the E-minis at that time on this daily price action. Okay, now if we look at the NASDAQ, which is amazing, you will see on the NASDAQ, we've actually made new all-time highs. That is a very bullish sign. You can see right here where the former all-time highs, right in that area there. Well, that's the wrong. Let's hit the right one this time. These were the former all-time highs right there, 7,047.25. We actually took it out by about 80 points on Wednesday. We gapped up, and then we just did not look back. We've made new all-time highs. However, we got what looks like a poor man's bed setting up that would suggest a little bit of a softening in price, probably back down to this point of control area where you see the volume over price sitting around 6,900 area. So a little bit of a softening in price just to give the markets a little bit of rest. But the fact that we made new all-time highs in NASDAQ will be a good thing for the rest of the markets. And if we look at the Russell, which is small cap and mid cap, it's been trailing everybody. But it started to pick back up again because they are less affected by steel tariffs and other machinations of the Trump economy or administration, because they've been lagging the rest of the markets for quite some time. But on a chart here, looking at this daily, it looks stronger. The only one that's stronger right now is NASDAQ. The Russell is stronger than the E-minis. You can see it's over the 50 EMA, well moving up towards the all-time highs. So we're going to watch this very closely. But that's kind of where we're sitting right now with the markets, guys. Very strong. And then, of course, if we look at the VIX, as I said before, VIX is going to maintain a higher level. We're in the lower end of the yellow, but I would expect it to kind of stay elevated for quite some time. You can see 2017, we were just down here, and people were going short vol with the ETN product XIV, which is a reverse. It goes higher, but then because there were so many people playing short vol in the markets, primarily in the futures market, when we had this catastrophic event here, it forced them to exit their shorts, and that aggravated the movement of the VIX. You can see here the VIX really closed around 37.25, but it moved up over 50 just in that extreme push higher to flush out everybody, and it caused the downfall of XIV. And then you can see the VIX is coming back down in here. Up in this area here, we were shorting VXX. All right, and we had some nice limited risk trades that I posted in our chat room for our members to play with on VXX, and we just shut it down this past Friday for profits. So you can see where the VIX is. I think it's going to stay elevated for a bit. I do not think the VIX is going to come back down around the 11 and 12 area anytime soon. Every time we've had a vol spike like this, the skew stays elevated on the deep out of the money puts. And the at the money puts stay elevated a little bit longer than normal until things work out. It typically takes 2 to 3 months for things to work back out again. Okay. So that's kind of what I'm seeing on the VIX. And then, of course, if we look at treasuries, as I said at the very beginning, the markets are changing. You can see this down move here. Now, for our members, I was short bonds during this run down here. Okay. And you can see here, even with this big move higher that we've had in the markets off the lows, traditionally bonds are the big move lower rather in February. Look at February here. You can see here, even with the early February move, bonds really didn't end up coming back up here. They stayed subdued. That's why this parity between debt and equity is now starting to change. And big money can no longer rely on just running to bonds as a flight to quality when equity markets start coming down. I do believe we're going to see more changes in this area, and I think bonds, if they do move higher, are going to be subject to a lot of shorts coming in and basically pushing them back down again. There are a number of different ways to trade this yield curve. We're going to look at some of those this year in our secret trader. But you can see here where we're just sitting right here testing these lows. Now, I said the lows for bonds would probably, you can see the partial of this colored bar on the screen right here. I said bonds would probably come down to about 140, 30, 27 ticks, somewhere down in this area here. This is based on a combination of Gann and Fibonacci extensions from up in this area right here. So that's where this is marked on the chart. And we're timing wise, you can see these two black bars show the timing, which is more of a Gann aspect of it. And then the price action is more the fib node. But it's suggesting that bonds can still run a little bit lower. And you can see the MACD. There is no signs. We're getting signs now of some consolidation. If we get 3 rate hikes this year versus 4, I think it'll still be a tendency for the bonds to kind of just grind lower is kind of what we're looking at here on the bond market. And then, of course, if we look at currencies, the dollar is still in its funk. You can see here it's trying to hold up, but I had projected the bonds coming, or the dollar coming back down even lower down in this area right here. You can see my original projection right here is kind of like we got a lot of volume over price. So this is a fair value number right now for the dollar, but I think price action may push it a little bit lower. By the same token, the euro is just the opposite. You can see the euro, we're off of the 2018 highs. This was the euro is almost at fair value right here. You can see this volume over price, kind of a point of control area, right around the 123. I think we're going to kind of hold up above this area here and slowly work a little bit higher, but I don't think we're ready yet to get up above 1.25. Super Mario Draghi came out last week, and as usual, he was very dovish, and he said we're going to keep rates very low. Their rates, by the way, are 0, or their bank deposits are at 40 basis point, a short 0.04%. So they have negative rates for the bank deposits. They want their money circulating in their economy. So we're kind of at this area right here. So I would expect this to hold. If it breaks, the euro is going to fall and the dollar is going to move up very strong. We may get some movement lower in the euro and some movement higher in the dollar when they raise the rates on March for the FOMC around the March 20 area. So we'll see how that plays itself out. And then, of course, gold. Well, you guys know my comments on gold. I've been basically neutral to bearish on gold most of this year, and you can see it's just chopped. We're making lower highs. We're kind of holding up here. You can see where we opened at 1305 for the year. We're slightly in the green, but we're just barely. That's a very difficult thing to trade longer term. I think we're probably going to come back down just a little bit. So I am not trading gold at this time. I do believe it's neutral to slightly down. Oil, very interesting. We had a very strong day on Friday. $2 up. I mean, it's really strong. Oil has been really choppy. I mean, it is all over the place. You can see in January, we moved up 10.73%. And in February, we fell 12.89%. And now we're trying to make up that area. And we're kind of right between two control points. So I do believe we're kind of sandwiched between the 63.50 area and roughly around 61.40. I think what oil is doing is trying to find an equilibrium price somewhere around 62, 63, and it may hold this area for a bit before it decides what it wants to do when it grows up. Okay, because it's bouncing off of these 2018 lows that we made when the markets imploded in early February. A lot of this was not as a result of oil inventory build. It was more a result of margin calls because oil built up so many longs. In the commitment of traders report, there were an abundance of longs in the futures market. And when the market's turmoil started in February, it forced them to sell off. So that's kind of what happened here. And they had to make some margin calls, so they had to unload a lot of their longs, and that caused oil to overextend to the downside. Now oil is just coming right back up around 50% of this move right here, and I think we're going to find a little bit of an equilibrium. In the middle, though, it's just been extremely choppy. All right, everybody, that's kind of where we're sitting for the weekend. We got a lot of really cool stuff coming up. We're in the middle of our option masters. If you're not in it, I highly encourage you to come in. It's probably going to be over 200, 250 videos. That'll be really great for you. And if you're not a member, I would encourage you in as well. We've got an international audience, and we continue to be growing all the time. So come on in and join us. Otherwise, make it a great weekend. Folks, members, I will see you this Sunday night for our weekly market watch, what we can see for the coming week. Have a really great day, folks, and good weekend, and I'll talk to you later.